You're listening to the Limitless Wealth Method podcast. Smart ideas, real strategies, and candid conversations for business leaders. Here's your host, Jason Hilliard.
What's up, everyone? This is Jason Hilliard. Welcome back to the Limitless Wealth Method podcast. My effort to share the ideas, strategies, and insights that help entrepreneurs, executives, and investors build wealth and live without limits. If you're getting value from this, it would mean the world to me if you would subscribe on your favorite platform, watch episodes on YouTube, and share with just one person in your network who'd get something out of it. My goal is simple: help you grow your wealth and your life, one episode at a time. Let's get into it. All right, quick question. What if the next big risk isn't a recession, but a bubble? Because the economy can feel weak at the exact same time markets get stronger. And if you misread that environment, you'll do two things that destroy wealth. Number one, you'll sell out of fear near the bottom. And number two, you'll buy out of FOMO near the top. So today I want to walk you through why 2026 is shaping up less like a classic downturn and more like a liquidity-driven bubble environment, and what to watch so you stay on the right side of the cycle. I want to talk about where the U.S. economy is likely headed as we move into 2026, and why I think the next phase of the cycle is being misunderstood. Because when people hear slowing growth, rising employment, and sticky inflation, they instinctively think recession. But when you step back and you look at the data, the policy backdrop, and the liquidity cycle, this doesn't look like a classic downturn. It looks more like an environment where asset bubbles expand, even while the real economy feels uneven. All right, so the core question is simple. Are we actually setting up for a classic recession? Let's start with the fundamentals and why most of the usual recession signals aren't there. Let's start with the big picture. Most recession models aren't flashing red. Consumers aren't over-levered the way they were in 2007, although credit card and student loan delinquencies are on the rise. Corporations locked in low-rate debt years ago. The banking system isn't cracking, although recently the repo market was showing signs of stress. Growth has slowed, yes, but it hasn't collapsed. This looks more like a U-shaped slowdown where growth bottoms and then reaccelerates into 2026. The key problem is that employment is lagging growth. And when growth recovers without jobs, it changes everything. What would change my view is a true credit event. Maybe we have banking stress, corporate default spiking, or consumers suddenly forced into deleveraging. Or maybe we have disorderly move on the long end of the curve, where long-term rates spike fast enough to tighten conditions and stress market functioning, forcing the Fed to respond with liquidity tools, or if things get severe, returning to quantitative easing or yield curve control. So if this isn't a classic recession setup, what's the real pressure point? It's the labor market, because employment is where the slowdown shows up last and where policy reacts fastest. Labor market is quietly weakening. We saw that in this week's jobs numbers. Hiring is slowed, underemployment is rising, job switching has collapsed. That matters because wage growth comes from people changing jobs. When people stop changing jobs, wages flatten. And even if inflation hasn't fully gone away, that's the definition of a jobless recovery. And jobless recoveries force central banks into a very uncomfortable position. They can tolerate sticky inflation. They cannot tolerate prolonged labor market weakness. And here's where the cycle gets weird, because at the exact moment the labor market is cooling, we have a force that can keep output strong without hiring: productivity driven by AI. So now layer in the most important wild card in this entire cycle: AI-driven productivity. AI doesn't need to eliminate millions of jobs overnight to matter. It simply needs to allow companies to produce more output with fewer workers. And that's already happening. When productivity rises faster than wages, inflation pressure eases, even if inflation doesn't fall cleanly back to the Fed's 2% target rate. So you get this unusual setup. Inflation stays sticky, but it doesn't reaccelerate. And that gives the Fed a little bit of cover. The Fed can now say, yes, inflation is still elevated, but productivity gains are doing the work. That's how you end up with rate cuts in an environment that historically would not justify them. AI creates a deflationary impulse inside an inflationary system. So if AI is helping cap inflation without the economy fully breaking, that changes the Fed's job because now the Fed has a narrative and a justification to pivot sooner than people expect. And this brings us to the Federal Reserve. Officially, the Fed has a dual mandate: inflation and employment. Unofficially, employment is winning. The Fed has already started easing. Markets are pricing multiple cuts in 2026, 2.5 to be exact. And this isn't just about economics, it's about math. The U.S. is running massive deficits. Treasury issuance is enormous. Debt levels are politically untouchable. That puts the Fed in a position called fiscal dominance. In plain English, rates cannot stay high forever without breaking the system. So policy stays easier than people expect and stays easier longer. And once you accept that policy is likely to stay easier than the headlines suggest, the next question becomes, where does that liquidity go? Historically, it doesn't show up evenly in the real economy. It shows up in asset prices. That's where bubbles are born. Now, let's talk about bubbles because this is where the data gets very clear. Global asset managers are extremely optimistic right now. In fact, according to Bank of America's Fund Manager Survey, bullish sentiment just hit 7.4 out of 10. That level of optimism hasn't appeared, well, it has appeared only 8 times since the year 2000. And every time it's happened, markets didn't roll over immediately. They inflated first. And one of those periods was late 2010 into early 2011. Liquidity was improving, rates were low, and growth was okay, not spectacular. From November 1st, 2010 through the market peak in April 2011, the S&P 500 rallied 16%. Bitcoin rallied 1,340%. That wasn't because the economy was perfect, it was because liquidity overwhelmed fundamentals. Another parallel was late 2020 into early 2022. Same setup: massive liquidity, easy policy, extreme optimism. From November 1st, 2020 through the market peak in January 22, the S&P 500 rallied 49%. Bitcoin rallied 233%. Again, bubbles inflated before the cycle broke. That is why I believe the probabilities are high that we see larger bubbles in stocks, gold, silver, and Bitcoin as we move into 2026. Not because fundamentals are flawless, but because liquidity, policy, and positioning align in that direction. Gold benefits as real yields compress. Bitcoin benefits as liquidity expands and currency debasement becomes more visible. Stocks benefit as discount rates fall, even if earnings growth disappoints. Now, before you hear bubble environment, assume it's straight up from here. There is a catch, because when optimism gets crowded, markets don't reward you immediately. They frustrate you first. Now, there is an important caveat. Bullish positioning today is crowded. Cash levels are low. Optimism is high. But the economic data is underwhelming. That makes it difficult to push meaningfully higher in the short term. Markets can stall, they can chop, which they have been, and they can correct. This is how people get shaken out, not because the cycle is over, but because the timing feels wrong. But short-term positioning isn't the same thing as the cycle. Crowding can create pullback, sure, but liquidity is the bigger force, and it tends to win over time. But liquidity cycles don't operate on short-term positioning. As liquidity continues to improve and rate cuts move from expectations to reality, the tailwind for risk assets strengthens. That's when bubbles inflate, not in straight lines, but persistently. This is how markets can feel frustrating now, euphoric later, and dangerous at the end. When I say liquidity, I mean the direction of rates, the pace of credit creation, treasury issuance dynamics, and whether the financial conditions are loosening or tightening. So when you zoom out, the message is pretty clear. This isn't about collapse, it's about excess. And if you understand that, you can stop reacting emotionally and start operating with a real plan. So let's bring this home. If you take one thing from today, it's this: 2026 doesn't look like a recession setup. It looks like a liquidity-driven bubble setup inside an uneven real economy. And that's a very different game. In a recession, the playbook is defense. You protect cash flow, you preserve capital, you expect broad weakness. In a bubble environment, the danger is different. The market could get stronger while the economy feels weaker. That's what creates confusion. That's what creates bad decisions. Because people see layoffs, they think, sell everything. Then they see markets ripping higher and they chase at the top. So here's the real framework I want you operating with. Number one, watch liquidity, not headlines. Liquidity is the tide. Fundamentals are the waves. The tide wins. Number two, expect chop first, euphoria later. This phase is where people get shaken out, not because they're wrong, but because they're early. And number three, respect the end game. Bubble environments don't end with a soft landing. They end with excess. So you don't just need a plan to participate, you need a plan to survive the last 10% when everyone's convinced risk is gone. And this ties directly back to what we've been talking about. AI isn't just a tech story. It's a productivity shock, a margin story, a leadership filter. It's deflationary in the real economy, but it can be inflationary in asset prices because it changes what investors believe is possible. So the question isn't, are we headed for a recession? The better question is, what's the cost of misreading this cycle? Because if I'm right, the biggest mistake people make into 2026 won't be being too cautious. It'll be being emotionally reactive. And the goal here is simple. Stay rational while others get euphoric. That's how you build wealth in cycles like this. If you got value from this, share it with someone who's been calling for a recession every 6 months. And if you want more episodes like this, money, markets, leadership, AI, and building wealth without limits, make sure you're subscribed. And to everyone listening, Merry Christmas, Happy Holidays to you and your family. I very much appreciate you listening, and I'll talk to you soon. And one last thing, if you want to learn more about working with me or my firm outside of the podcast, there will be links in the show notes. Thank you very much. Happy holidays.